I also have to thank you for that very interesting presentation you gave on Friday, where you signaled caution on monetary policy. 5 big reasons why you think the Fed should not continue to hike rates. We'll get into each of them, but broadly, what are you so concerned about? What is the risk here in Fed moves?
I think global interest rates are still low, and I think we have to keep that in mind, and so that what's normal today is lower than what it's been in the past. And people have been talking about this for quite a while, but I don't think we can't lose sight of that is the main idea.
Okay. And it seems to me of all the 5 cautions, the most urgent one is yield curve flattening. In fact, you said that it's getting close to crunch time on the yield curve that could actually invert relatively soon. What's driving it? Why is this happening?
Well, if the Fed goes up 3 times for the rest of this year, that's 75 basis points, and you have to ask yourself, is the 10-year really going to go up that much over that kind of time frame? If it doesn't, we're going to have an inverted yield curve later this year or early in 2019. So, I do think it's crunch time for this. I think those that are more sanguine on this issue feel like the 10-year will rise, and we have seen the yield going up here in the last day or two. But the question is, how is that going to proceed over the remainder of this year and into 2019? I don't think we're in any danger right now, sitting here today. The yield curve has a nice upward slope, and that's fine. It's not too far off the average slope over the last 30 years or something, but I'd be concerned that we not march into an inversion without our eyes being wide open.
And I'd like to add the 10-year note trading at 3.08%. I believe it touched on 3.09. That was a really big move yesterday. But let's just follow on something you just said. You said unless the 10-year note yield were to go up, commensurate with the Fed, I guess that would be another 50 basis points. But there are people on Wall Street right now saying that we're going to get to 3.5% by the end of the year, maybe even a little bit higher.
On the
10-year note yield.
On the 10-year, yes. But people are also saying the Fed's going to raise rates 3 times, so that would be 75 basis points. So that would be even flatter yield curve than what we have today. So I tried to get this debate going with a talk late last year and late November last year. And I think it's a good debate to have at the Fed, and I think that the other members are talking about it, and I think that's the important thing at this point.
The risk is recession?
Well, if the yield curve does invert, and we're not there yet, but if the yield curve does invert, I would take that as a bearish signal for the U.S. economy, because it means that the market has a different view of the future than what the Fed has.
So is that your big concern here, that the yield curve inverts and we get a recession next year?
Well, no. The yield curve would invert. That would send a signal. You could argue about how good that signal is, but the San Francisco Fed study on this that came out recently on their letter said that it's been a pretty good signal of problems ahead for the U.S. economy. So I don't think you want to get into that situation without thinking it through.
Jim, a lot of people, starting in the Great Recession and through QE1, QE2, QE3 have complained, particularly in the bond market, that the signal now from the bond market, you don't read the kind of message from the bond market, the Treasury market, that you used to because of the massive bond purchases. People
say this time is different. I mean, this thing has sent a good signal ever since the 1950s about what's going on it's a good signal for the U.S. economy ever since the 1950s. So I'd be very hesitant on arguments that this time is different. The other feature of this is the Fed marches ahead and inverts the yield curve. To me, that's an unnecessary thing to do at this juncture. We don't really have the kind of inflation problems we had in the 70s or early 80s. And so you don't really need to press that hard in this situation as you might have in the past.
So let's move on to another one of your 5 cautions, and it's actually number 1 on your list. I don't know if you rank them in order of importance or just what came to your mind first, but inflation expectations. And you note that market-based inflation expectations, first of all, I say they're low because of Fed rate hikes. The Fed is causing that. And secondly, that they are still below 2%. Why is this such a concern?
Well, I think I like the market-based measures because they're giving you a daily signal about what markets are thinking. They are CPI-based, so you have to adjust them to a PCE basis, so I think that's important. If you do that, they're still saying that the Fed's not really going to hit its inflation target even over the next 5 years. They're saying that inflation will actually be somewhat below target on a PCE basis over the next 5 years. So that doesn't sound like much of an inflation problem in the U.S., to me, at least in the eyes of the market. And I think that's because the Fed has already moved off zero. The Fed has already started to shrink the balance sheet, and those preemptive actions have kept inflation expectations under control. So we're already in a situation where we've taken preemptive action to keep inflation near target, and for that reason, I don't think we need to do a lot more at this juncture.
Another thing that's already happening, you say, is the policy rate is already neutral. So we're talking here about Ourstar. Elaborate on this. What Ourstar means, where it is now, and the FOMC is kind of dispersed on what Ourstar is, right?
Yeah. John Williams and his co-author Thomas Lubick have convincing evidence that this so-called Ourstar is a lot lower than it used to be. I think the simplest way to think about it is as the trend measure of the short-term real interest rate. It's the trend component. The Fed does influence that rate, but it doesn't influence the trend. So the question is, where's the trend rate? I say it's probably still negative today, and so if you take that as a starting point, a real short-term real interest rate being negative, you add 2% inflation to that, you're going to get something less than 2% as the neutral federal funds rate. And we're already right there. So that's the idea, is that we're pretty close to neutral today. If we start going up from here, we're going to get into restrictive territory, which is going to put downward pressure on inflation. Do we really want to do that when inflation expectations are already hovering below our target for the next 5 years?
Why do some of your colleagues have higher neutral rates, 2.5, 2 3/4? Some seem to be up around 3.
There are a lot of estimates around it. It has wide confidence bands around it, so there is certainly room for argument on this. But I think it's probably pretty low. It's also a global yield, so global rates are really low, and our rival central banks in Japan and Europe still have negative policy rates. So the idea that the U.S. is going to break out of a global equilibrium that's really low, I think, is not that likely. You say
business investment has room to grow. You say that if corporate tax reform is successful, the economy can grow faster without inflation. Another argument for, hey, you don't need to be so needing to raise rates. Do you really think that tax reform can boost investment and potential GDP so quickly?
The idea of corporate tax reform was to reform the U.S. corporate tax system. I think that part of it was a great move. That should normalize business investment in the U.S. More machines, more technology should make U.S. workers more productive. That should be a positive for the U.S. economy. That is supply-side driven growth, which should not be inflationary. So I'm pushing back a little bit against the people that would say everything that happened with the tax reform is coming on the demand side and therefore is inflationary. And even that argument, if you want to make that argument, I think that's a temporary effect on inflation, not a permanent effect on inflation. So I think even if you wanted to react to that, it should be a temporary reaction on that side.
Your fifth caution is, drumroll please, labor markets are in equilibrium.
Yeah.
And you say some supply and demand are balanced, from workers versus companies. But, I'm thinking about the labor market. Unemployment's low and falling. Wages are barely rising. There are so many unfilled positions. You can't find workers, skilled workers. We hear that from a lot of companies. What kind of equilibrium is that?
It's a lot better equilibrium than it was 10 years ago. We had unemployment at 10% here in the U.S., and we've been working to whittle it down ever since. And you've had other measures of labor market performance that were kind of off the charts bad 9 or 10 years ago. They've all come back to good levels, better levels today. But I want to think about today as being the equilibrium and yesterday as being the disequilibrium. So now you've come back to a more normal functioning labor market, which I like. We all like that. But that is normal. You shouldn't be wanting to disrupt that now through Fed actions and mess that up. You want to let the labor market be in its normal state. That means competition for labor, sure. But it also means that firms have to weigh the decision about how much labor do I want to hire versus how many machines do I want to bring on versus how much technology do I want to bring on. Do I want to, am I willing to pay my workers more, or do I want to invest more in technology? That'll keep the labor market in check. That's a good equilibrium.
That's why you're not worried about overheating like so many of your colleagues.
I think the overheating story is actually very hard to tell. It's very hard to tell.
Why?
Because the overheating story doesn't take into account this dimension that firms have to adjust their capital. They've got two factors of production. They can hire more labor, they can pay more there, or they can say, no, that's too expensive, I'm going to add more technology over here. And you'd like to let them go ahead and make that decision. 10 years ago, we had workers lined up outside the door, and they maybe didn't have to make that decision. But now they do. I consider that an equilibrium situation. So that's why I'm trying to push back a little bit against the overheating argument.
What would change your mind? What would bring you around to the side that says consensus baseline, 2 more rate hikes for a total of 3 in 2018? What do you have to see to change your mind?
I think you'd have to see surprises in the data to the upside beyond what's actually being forecast right now. So people are already forecasting, inflation slightly above target. You'd have to see inflation breaking out a little bit more to the upside, possibly, stronger than expected growth, strong labor market performance, above and beyond what we're already expecting to happen. I don't think that's all that likely, so that's why I've got the outlook that I have.
A week ago, Fed Chair Jay Powell gave a speech looking at emerging markets and movements of central banks and the Federal Reserve, and pretty much the argument seemed to be the Federal Reserve does not have too much to do with the recent sell-off in emerging markets, the volatility, that moves are transparent, they're well telegraphed, emerging markets are in better shape than they were, they can handle this. We look at Indonesia and its currency weakening. We're looking at Turkey's, having to raise rates. We're looking at Argentina having to push rates up so high all of a sudden. What do you think of that? Do you agree with that the Fed has very little impact on emerging markets? It doesn't have to be concerned with this as they change policy?
I'm in agreement with the chair's speech on this. I thought he did a good job in this speech. And this is not really a new issue. This is an issue that's been around over the last 6 or 7 years, getting pushback from emerging markets. But I think the story has to be and will be that the Fed's charge is to make good monetary policy for the United States, and that other countries have to follow their own monetary policies and management of their own exchange rates, and to the extent they can. I'm sure they'd like to have maybe more influence over U.S. monetary policy, but we have to run monetary policy for the U.S. Well, we're certainly cognizant that there's feedback from emerging markets, and we are taking that into account. But there are a lot of countries out there, and we can't do everything for everybody. When
you raise this red flag, this caution to the Fed, be careful. We got to proceed slowly. Maybe we shouldn't raise rates more. Are you looking at that kind of thing? Yield curve flattening is on your list, but we've got a stronger dollar. Financial conditions are tightening. There is concern and volatility in emerging markets. Concern about global growth peaking, particularly with oil prices rising. Are you concerned that maybe the Fed, especially if you take in these internationally, these global factors into account, the Fed's entering a dangerous zone now and not really focused on these conditions that are changing around it domestically and internationally?
Yeah, I guess my main point would be that the idea has been that the Fed was so far out of position with zero real interest rates and a big balance sheet that anything we did was just kind of, inching our way back to some kind of ordinary situation. And so you didn't really have to think about reacting to the data. But now, I think we're well off the zero bound now. The balance sheet is shrinking now. Now you've got to take into account much more carefully, as you would in normal times, much more carefully, exactly what's happening in the economy, and you have to be a lot more careful about moving rates around. You can't just say, oh, we're going to be on autopilot because we're so far off of what normal is. We're actually very close to a more normal type of monetary policy that would be reacting to data as it comes in.
Is the bigger risk for the Federal Reserve an economy that overheats and inflation rises and they have to speed up the pace of rate hikes? We've heard that from a lot of Fed officials. Or is the bigger risk that the Fed keeps hiking rates, hikes too much, and we get pushed into recession?
I think the bigger risk is the latter one, where you know, we overdo it and don't react to data enough. But I do trust the judgment of the committee, and I think the committee would be very thoughtful about this. There is no reason why we have to err on one side or the other. We can be thoughtful as we go forward and make just the right moves that'll keep the expansion going. So
you think this market that is market expectation that is shifting a bit more towards maybe there will be 4 total rate hikes this year instead of 3 is
the whole idea that you're naming the number of rate hikes way out in the future when you don't know what the data is going to be is something we should get out of the business of doing.
You mean the dot plots?
Yeah, I don't think, you know, when you're at 0 and you're giving forward guidance, that's one thing, but we're not at 0 anymore. We never gave forward guidance of this nature in this kind of situation where you're well off 0 and it's not that clear where rates are going to go in the future. So I think piling up these rate hikes over the next 2 years or 3 years or something like that as some kind of inevitability, I don't think we should be doing that. We should be more Greenspanian in the policy where you say, we think we have the rate about where it needs to be today, and we're going to monitor developments and we'll react to what happens in the future. That's how we would like to frame this, I think.
John Williams, incoming president of the New York Fed, spoke to Bloomberg News today, and one of the things he said I found very interesting, and everyone did, that forward guidance, maybe it's just about time to put that one to bed. I guess sort of end the market hand-holding. Do you agree with that?
Yeah, one of the things in the statement is that monetary policy remains accommodative, and I think we used that same language when we were at 0, and now we're way off 0. We're still using the same language. It's become dated, so I think we have to modify that in some sense. I would like to say, you know, we're at neutral, but whether I can convince my colleagues to say that, but I don't know. But I do think we should reform that and then think about the dot plot as well, I think.
How about the inflation target? How about we have to have 2%. There's been talk now of a range. But you know what, Jim? You remember the olden days. What did Volcker talk about? What did Greenspan talk about? Price stability. And look what happened to inflation with nothing more than price stability as part of your dual mandate. A steady decline.
Mm-hmm. Yeah, the inflation target has been quite successful in keeping inflation low and stable. And if you look at the average, you know, inflation rate since the mid-1990s, if anything, it's been a little bit too low compared to a 2% target. So it's been quite successful.
But neither Volcker nor Greenspan had a 2% target. All they talked about was price stability.
I think we had an inflation target of about 2% beginning in about 1995. Once we got to a low level. So I would say that Volcker disinflation went from, let's say, 1979 when Volcker came into power all the way out to 1995. Once we got to that point, there was more or less implicit agreement that 2% was the target. An international standard was being set at the time. You had New Zealand, Australia, Bank of England, formation of the ECB. All of those were naming targets that were or principles that were centered around 2%. So that's I think happened implicitly in the United States.
Rising oil prices, is this something that is going to be inflationary domestically, globally? Is this something that will be deflationary because it will sap consumers' resources, raise costs for businesses?
Oil prices have been going up, and the analysis that I've seen suggests that they're going to remain at these higher levels, at least for a while. It will stimulate U.S. production. How fast that comes on board, I think, is a great question. U.S. probably will be the world's leader in oil production. I'm still flabbergasted by this, but that's the reality today. So I think the effects on the U.S. economy are far more ambiguous than they once were. We take a hit on the consumer side and on those that pay more at the pump for their gas, but we also get a boost on the production side as we get more jobs in the horizontal drilling fracking area. So I think it's more of a wash for the U.S. economy than it once was, and that's all changing quite a bit from the way we thought about it in, let's say, the 1990s.
One angle, I think, one aspect of this, you're concerned about the Fed raising rates, got a rising dollar. For a long time, Fed was raising rates, the dollar didn't rise. Now it's clearly rising. Is that a concern? Is that just a logical outgrowth from the Fed raising rates? Is that something the Fed needs to be cognizant of?
Well, we certainly take currency fluctuations into account when we're trying to forecast what will happen in the U.S. economy. This dollar rise has been forecasted for a long time, but it not materialized till recently. So I think jury's still out at this point as to what the effects will be.
Fed says it's on the path to normalization, and clearly most Fed officials are ready to continue. You say the Fed should pause. Do you think the Fed has already reached the point of normalization? Is that kind of your point? Do you have a different view of normalization? What's normalization anyway after what this economy, what this monetary system went through the last 10 years?
I think we're close to neutral today, or even at neutral today. You've still got an environment where, globally speaking, the short-term real interest rate is quite low, probably negative. And if you add 2% onto that, you're going to get a neutral federal funds rate that's less than 2%, which is where we are today as far as the funds rate. So, you know, I just don't think in this, and we don't have much of an inflation problem, nor does any inflation seem to be on the horizon according to market-based expectations. So my advice would be stand pat where we are. Certainly watch the data carefully, watch for surprises, and adjust accordingly from here. But I don't think we have to scramble to get to some higher level of rates in order to contain inflation. I just don't think that that's the right way to think about this environment. I'm an inflation hawk, and if if inflation was up at 3%, I'd be all for pounding the table that we had to get this under control. But that is not the situation we're in, and it's just not showing up in market-based expectations, I don't think.
This issue gets raised a lot. Let's raise it again. What is the global inflation dynamic? The ECB, the latest number, again, for the euro area, falling back a bit. They're having a hard time. Yes, hard time hitting their target.
Yeah.
BOJ, well, they're about halfway there. They've made a lot of progress, but a long ways to go on hitting a 2% target. Yeah. Many industrialized nations can't boost inflation. What's going on?
Well, one thing that's not going on is overheating. If you look at the Japanese economy, their unemployment rate is one of the lowest that they've had in a long time. They're not really seeing the wage growth that they expected and so on. So Japan also had a down quarter in the first quarter. We got that news today. And then Germany is another place where they've had a very good high-performance economy. They've had low unemployment rates. They're not really seeing a lot of inflation out of that. So I think that tells you that the global situation is one of low and pretty stable inflation. This is not a situation like it was in the 70s where inflation credibility was much more malleable. Today, the central banks have a lot of credibility on inflation. That's keeping inflation low and stable, and that's all separate from what's going on in labor markets. That's why I'm pushing it back against this labor market overheating story and reminding people that firms have the option to also invest in capital.
Jim Bullard, thank you so very much.
Thanks a lot.